Hey you guys, what's happening? Welcome to today's video. Hope you guys are doing great today. This is Chris from Verlo Trading, and I just wanted to make a video today about something I've been thinking about, something that I kind of had a bit of an aha moment, but also it's a really interesting topic. So this video is for educational purposes only, and that's pretty much it. If you enjoy this content, leave a like on the video. Let's get to it. So we're going to talk about what is subjective versus objective analysis and how it applies to trading and how it applies to markets. The point of this video is not to say what is right or what is wrong. It's just to maybe plant the seed, and if you want, you can water it later. So let's get into the first point. I just want to make this nice and clear. What moves a market? What moves a market? That's the first question, and I will answer it for you, and you can disagree, but you might have a hard time disagreeing with this. It's how many bids, meaning how many people are looking to buy, how many offers, meaning how many people are looking to sell, and how many trades that are occurring in between that. Basically, supply and demand. If there's more demand than supply, generally price tends to go up. So what fundamentally moves a market? I'll say it again: bids, offers, and trades. All right, that is objective fact. Now, here's the problem. Today in 2021, traders look at this and they say, this is objective fact. And in a way, it is objective fact because that is what happened. It's a fact that the NASDAQ moved from here to here, then it moved from here to here, and then it moved there. That is a fact. However, this information that I'm displaying right here is not showing you what is moving the market, which is bids and offers and trades. Are we on the same page with that? So it could be said, charts like these, if misused, tend to be used as subjective means of analysis instead of objective means of analysis. And that basically comes down to how people are using the charts. Okay, so in 2021 today, some traders think that all they need is a chart and they can trade the market, but you're not taking into account that what moves a market is bids, offers, and trades. Now on this chart, do you see bids, offers, and trades? I don't see any. What we do see on the chart, however, is if the price moved up or down, and we see time-based rotations. In this case, each one of these bars represents 30 minutes of time. However, time does not move a market fundamentally. Time can change the probability of what a market does. However, fundamentally, it does not affect the price. Bids and offers and trades do. So do you see where I'm coming from when I say that there's this sort of gray zone between objective analysis and subjective analysis? I'll try and give you some examples now of how this applies to the real world. So in today's day and age, the news media in the system we're kind of in acts as like this scapegoat that is there to tell you kind of what's going on and why it's happening, basically. So if NASDAQ moved up today, they're going to tell you why. If stocks crashed today, they're going to tell you why. But if you actually take a minute to read into the why that they're telling you, you'll realize that it's largely subjective and it's not based on fact. Fact is, if the price moved down, there was probably more supply than demand. But they won't tell you that on the news because it's pretty damn boring. Imagine these guys on the television telling you NASDAQ moved up today because there was a passive buyer at the 70 handle and then the sellers got squeezed out up to 85. If they told you that, first of all, no one would understand what the hell they're talking about. They would be going against the industry standard, which is essentially to keep retail traders as clueless as possible. Okay, so guys, this is kind of a tough topic for me because I'm not an expert on it myself, but I'm going to try my best. So the next thing I want to talk about is how people tend to be making decisions from a subjective point of view rather than objective point of view, first of all. Then, when they analyze their results, they are using subjective analysis to review their subjective decisions, leading them to continue this cycle. This is kind of the danger zone when it comes to reviewing your performance as a trader. The more variables there are to your method that are not related to facts about what actually moves the market, the harder it's going to be for you to have any consistency in reviewing it. And the easier it's going to be for you to use subjective analysis when you're reviewing your results. So for example, let's say you have a certain method where you have a few different variables, and when these variables come together, you execute a trade. If your variables are subjective, meaning they're not based on what actually moves the market, then you're setting yourself up to go on that cycle of being a subjective analyst, reviewing your results subjectively as well. Hypothetically, our trader says this: if A, B, and C are present, then I execute a trade. Let's say he executes a trade and the trade fails, he gets stopped out. When he goes back to analyze his result, he's going to say something like A, B, and C were good, but actually C wasn't as strong as I would have wanted it to be. Do you see how it's very easy to become subjective with your analysis? That is why I personally strive when I'm reviewing my results to, first of all, base my trading decisions on objective fact. And second of all, review my trades based on questions that can be answered objectively. So instead of saying A, B, and C happened, therefore I put the trade, but then I got stopped out with a loss, I then realized that C wasn't as strong as I thought. And the next time I execute that trade, I have to wait for variable C to be more clear than it was. If variable C is not based on an objective fact, then variable C is not a reliable variable. That's kind of what I'm getting at. And I'm really having a hard time explaining this. I'm kind of in a gray zone myself with the whole thing. But basically what I'm trying to say is that trading based off of subjective analysis and then reviewing your subjective decisions with more subjective analysis, that's what traders are doing today in 2021. So that's what I'm getting at. Let's think of another example. So let's say our trader, he's going short, he gets a bit of a move, and then something changes, and then the market goes straight for his stop loss. He gets stopped out of the trade, and then as soon as he gets stopped out of the trade, the market reverses and goes where he expected it to go initially. Now, the majority of time, he's going to say something like, oh, I'm never going to use a stop loss because every time I use one, it goes straight for my stop and then it goes straight for my target. That right there is completely subjective because our trader is not using objective information to make that statement. Okay, if he now used objective information and said something like, when I entered the trade, I was initially correct, but then the conditions changed. There were more buyers than sellers. The price upticked at that point and it hit my stop. The moment it hit my stop, the sellers re-entered the market aggressively and the buyers pulled their bids, and then the market tanked and it went down to where my profit target would have been. That statement is more objective than I need to place my stop further away because if I put it right above the candlestick high, I'm going to get stopped out most of the time. That is not objective because candlesticks are not objective. They simply show you price going up or down and time, both of which are things that do not fundamentally move the market. Every time I trade and I go back to review my results, what I practice is I ask questions about the trades that can be answered with objective fact. So here's an example. I'm looking to bid on a price, and when I get filled on that price, I'm expecting the market to move swiftly in my favor, therefore get the edge. Let's say now I get the fill on the order, and all of a sudden my price that I bid on is now on the offer, and I see a lot of volume trading on the offer and it can't go above it. Well, I can state objectively that what I was expecting did not happen. Therefore, I was wrong to be bidding at that price, and I should reconsider my decision and scratch the trade immediately. I used an objective analysis of the current market condition to answer a simple question, which was, what did the market do versus what I was expecting it to do upon my order being filled? The problem that traders have is that when they're analyzing their results, it is very, very easy to come up with arbitrary reasons as to why their trades were either winners or losers. So basically, there's a tendency to go away from the true fact about what moves markets. What I encourage you to do, if you're serious about your trading and reviewing your results, when it comes down to reviewing your trades, try as hard as possible to ask questions that can be answered by analyzing the objective facts of the market. What moves the market? How many bids, how many offers, and how many trades that are randomly trading. There's nothing more to it than that. And of course, a chart like this does not show you that information, which is why I use a price ladder. I'm not saying you need to use that because at the end of the day, if you're getting paid, then just keep doing what you're doing. If what you're doing is working and there is consistency, by all means, continue to do it. The point of this video was simply to express my view of the situation, which is that a lot of people use subjective analysis when it comes to making trading decisions, first of all, and then they also use subjective analysis to analyze their subjective decisions that were made in the first place. So guys, please don't get into that cycle. I appreciate you guys a lot. I wish you all the best. Take care. Bye.